Good morning, sir. My name is Gui Carven. My student ID is 0323035. Contract for differences is a contractual agreement between an investor and an investment bank to pay the value difference of an underlying asset from the opening time of the contract until the closing time. For instances, a buyer of the contract will gain the value from the contract seller if there is an increase in the value of the underlying asset and vice versa. A trader can trade on the movement of the stock price without having to actually own the stock. There are four risks of contract for differences. The first risk is the market risk. This is the risk that investment market move against the trader's position. The second risk is the counterparty risk. This is the risk that CFD provider or another counterparty to a trade fails to fulfill their obligation to the traders. The third risk is the client money risk. This is the risk of losing some or all of the trader's money held by the CFD provider. The last risk is the liquidity, capping, and execution risk. This is where market condition and the mechanics of trading might mean the traders cannot make trades when he would like to, or that their trades are not filled at the price they expect. The stocks I have traded are oil for commodity, USD to Japanese yen for forex, USA 30 for index, and Apple for shares. The analysis tools I have used are fundamental analysis and technical analysis. Under technical analysis, I have used Bollinger Band and relative strength index. Fundamental analysis study anything that can affect the security value, including macroeconomic factors such as the overall economic and industry conditions, and microeconomic factors such as financial conditions and company management. I have used news and online articles to support my findings. Technical analysis. Bollinger Bands is a versatile tool combining moving average and standard deviation and is one of the most popular technical analysis tools. There are three components to the Bollinger Band indicator, which are moving average, upper band, and lower band. This is the moving average band, where the majority of price should be within the upper-lower Bollinger Band. The upper Bollinger Band stay above the average Bollinger Band, and very few closing price should be above the upper Bollinger Band. The lower Bollinger Band stay below the average band, and very few closing price should be below the lower Bollinger Band. The basic way a trader might trade volatility is that the traders try to buy options with low volatility in hopes that volatility will increase and then sell back those options at a higher price and vice versa. Since Bollinger Band adapt to volatility, Bollinger Band might give options trader a good idea of when options are relatively expensive, high volatility, or when options are relatively cheap, low volatility. This is the area where shows that Bollinger Band shrinking in width, volatility shrinking, stock price resting. This is where the traders should consider to enter the market. Relative Strength Index is a momentum oscillator that measures the speed and change of price movement. The RSI oscillates between 0 and 100. RSI is considered overbought when above 70 and oversold when below 30. Signals can be generated by looking for divergence and failure swings. RSI can also be used to identify the general trend. When RSI is below 30, it means the market is oversold, and when the RSI is above or exceeds 70, it means the market is overbought. Thank you.